So I'm starting. So what we did the first lesson. Sorry guys, I'm not going to share the screen again because the document I have it with me. So once I finish the lesson for currencies today, I'll just type what we did. Then I'll just send it to you. Then you can see on your own. But after this lesson from tomorrow going forward, I'll be sharing screen so that everyone will see. Okay. So on our previous lesson, I explained investment bank definitions to currencies. Where when I said G10 currencies, that is a group of 10 currencies. That is €1, US dollar, British pound, Japanese yen, Swiss franc, Australian dollar, New Zealand dollar, Canadian dollar, Swedish krona, Norwegian krone. And I also said some of these currencies, about 4 of them, they are commodity based. That is Australian dollar, New Zealand dollar, Canadian dollar, Norwegian krone. Then I also spoke about emerging currencies, where you find them in Europe, Middle East, and Africa. That is the one from Czech Republic, that's Czech koruna, CZK, Egyptian pound, Hungarian forint, Iceland krona, Islamic shekel, Polish zloty, Romanian lira, Russian ruble, South African rand, that is ZAR, Turkish lira, Ukrainian enva. And on these emerging currencies, we've got another 5. We've got 5 currencies that are based as commodities. They are based on commodities. The one from Iceland, that is Icelandic krona. We have got South African ZAR, South African rand, Russian ruble. We've got Turkish lira. We've got Ukrainian. Then we went on. Okay, then we've got the GCC, a group of cooperation council. That is commodity currencies that just depend on 1 or 2 commodities. We also have got emerging currencies in Asia. Chinese yuan, Hong Kong dollar, Indian rupee, Indonesian rupee, Kazakhstan tenge, Malaysian ringgit, Korean won, Philippine peso, Singapore dollar, New Taiwan dollar, Vietnamese dong, the one from Argentina. So on all these currencies, some of them they base on one currency, so on one commodity. Some of them they base on a number of commodities. Okay, so today we are going to talk about emerging currencies in Latin. I don't know, you call it Latin. That is Argentine peso, Brazilian real, Chilean peso, Colombian peso, Mexican peso, Peruvian peso again. So all the currencies in Latin, what they do is they all focus on commodity. All of them. They are based on commodity. So it means they based on a number of commodities. And like some of the currencies that we spoke about last time. Okay. Okay. Guys, I want you to take note here. There's information that I'm going to be talking about. And on this information, you need to make sure you understand, because it's all about currencies again. But the thing is, the way I'm going to be explaining it, I know you've never heard of it. but it's a bit confusing if you don't listen very carefully. So professional traders definitions now. I'm going to explain currencies in terms of professional traders. The one that I was explaining from the last lesson is from investment banks definitions. Now I'm going to explain using professional traders definitions. Okay. Professional traders understand that volatility creates opportunity in trading over any given time horizons. So therefore, professional traders organize or segment currencies in a different order to geographical segmentations. So what I'm about to explain here, we've got 4 main categories of segmentations that are used by professional traders. One, we have got X commodity floating. Not this. I said 4 main categories of segmentations. That means segmenting currencies in a way so that you understand. One, X commodity floating. Currencies that cannot depend on one commodity. Hope we are together there. X commodity floating. Currencies that are not dependent on one commodity. That's number one. So you should also know which type of currencies that does not or that do not depend on one currency. Let me give you an example of what I've just said. It's like the Canadian dollar, Australian dollar, New Zealand dollar, Swedish krona, those currencies. They depend on commodities, but not on one commodity. Hope we are together there. Then we've got X commodity pegged. X commodity pegged. This one now is a type of currency that depend on one commodity. Example, a good example is Singapore dollar. Singapore dollar is a currency that is pegged to one commodity. I will not say which commodity now, but I'm just giving you examples. Now, then we've got commodity floating. Number 3, commodity floating. Remember, I'm talking about currencies in a way that is used by professional traders. The previous lesson I was using definitions from investment banks. Now I'm using definitions from professional traders. Commodity floating, commodities that are not dependent on one or two prices. So these are currencies that are based on commodities, but not one or two commodities. This now depends on certain number of commodities. That is not either one or two. Number 3, commodity pegged. When I say commodity pegged, I'm now talking of commodities that are pegged to one certain price. Hope you are together there. Because remember I said we've got 4 main categories of segmentation that is used by professional traders. X commodity floating, number 1. Currencies that are not dependent on one commodity. X commodity pegged, currencies that are pegged to one commodity. Then number 3, commodity floating, commodities that are not dependent on one or two prices of commodities. Then commodity pegged is a commodity that is pegged to one certain price. Hope we are together there. Hope you are together. This information seems like it's an advanced information, but it's a basic thing that you need to understand before we go any further. Then, what is more important to professional traders is an understanding of what currencies are likely to be volatile. I know when you're still starting in trading, most of the times what you do is if you see a setup on certain pay, let's say today you saw a setup on GBP JPY, today you'll be trading GBP JPY. The next day, if you see a setup on Euro USD, you'll be trading Euro USD. The following week, maybe you are trading Asian pairs. The next week you are trading, I don't know. But if you come to realize that once you have mastered, or once you understand, or you have certain experience in forex trading, you end up choosing pairs. Let me not just trade everything. You find if professional traders, they normally trade 3 or 4 pairs, and they make billions of dollars from that 2 or 3 pairs. It's not about the number of currencies that you are trading. You are trading maybe 50 pairs when you are still starting, but once you have started, you are trading only 2 or 3 currency pairs. Because the most thing that is important, it's not about number of pairs, but it's about the volatility that will create opportunity in that whatever currency that you are trading. So that's why I said the most important to forex, to professional forex trading, or to professional forex traders, is the volatility that creates opportunity. What creates volatility, that is what is more likely to create opportunity, and what will create opportunity. So this is what is most important thing to professional trading, professional traders. So you guys, I want to help you on, let's say you are still starting and you want to choose pairs, what if you keep following us, we are going to get into a stage where we are going to explain a part of, let's say, psychological part that is in trading. So for now, we are going to focus more on these currencies. Once we focus more on currencies today, I'm going to finish on currencies. I think tomorrow Tag will be with you guys. We'll go to next chapter. He will tell you what we are going to be discussing tomorrow. So what I want you guys understand today, it's more of these currencies. Because remember, the most thing that I want you to understand, the definitions that we use as the retail traders and the definitions that are used by investment banks are also different to the definitions that are used by professional traders. So first lesson, we explained how the investment banks defines the currency. Now I'm talking about professional traders. So I want to repeat on these 4 main categories of segmentation where professional forex traders define these currencies. Number 1, I said X commodity floating. That is currencies that are not dependent on one commodity price. That is number 1. Number 2, we have got X commodity pegged. Remember, the first is X commodity floating. Number 2, X commodity pegged. This one now, it depends on one price of a certain commodity. So if you know this pair is pegged to one commodity price, and you find out which commodity price this currency is based on, your trading will be very, very easy. So you'll be monitoring how that commodity price is moving. The result of the movement is the result of, or the direction of that currency pair. Hope you are together there. Then number 3, commodity floating. Commodities that are not depend on one or two prices. So what do I mean by this? Is when one currency or whatever number of currencies, they depend on certain number of commodities. So it means maybe 3 or 4 commodities determines the direction or the movement of a certain currency. Especially I said what is it? What did I say? I said about spoke about okay, the New Zealand dollar, and also I spoke about the Senegal dollar, something that is detailed, that uses one price for one commodity. Let me keep on looking at my notes. What I wrote, also what I want you guys to also explain. Okay. Because if I don't explain this, what I will do is I will also send you these notes in a paragraph way, or okay, in a diagram that will be very easy to understand. Because if you don't understand one, you will miss everything. So if you understand stage by stage, it will help you to know or understand these currencies. Okay, now I also want to explain the differences now between X commodity floating, commodity pegged, commodity floating, commodity pegged. I think that will help you to understand much better. Okay. We have 46 currencies in total. If you open your MT4, MT5s, most of the brokers, not those fake brokers that are coming these days, but I'm talking of the big brokers, 36 are floating, 10 are pegged or fixed regimes. When I'm saying 36 are floating, those are the types that do not depend on one or two prices. And those 10 are pegged or fixed regimes. So the fixed ones are the pairs that use certain price or one price of a certain commodity. It's like, let's say, in South Africa, ZAR, let's say it's based on gold price. Whatever happens to gold will always affect ZAR. I'm just giving an example. I'm not saying ZAR is pegged to gold only. Yes, it's pegged to gold, but not gold only. So it's an example. So 36 currencies are floating. It means for whatever currencies that you are trading on your MT4, if you open your MT4, MT5, 36 of them are floating and 10 are pegged. This potentially limits our opportunity to 36 currencies in the spot market. Why? Because imagine if you are trading something that is pegged to one certain commodity, like what I was saying in the previous lesson, where I said they may decide that the price for this commodity for the rest of this month is going to stay at a certain level. It will remain there for the rest of the next month. So those type of currencies, you should also avoid trading them. So you should trade currencies that are floating, that are not pegged to one certain commodity. Hope we are together there. This potentially limits our opportunity to 36 currencies in the spot market because pegged are fixed regimes, meaning the currency is controlled by the central authority of the particular country to trade within very tight specific ranges. So this is the reason why you should not trade currencies that are pegged to one or that are controlled by central government. 17 of the floating currencies are X commodity. I hope you still remember what is X commodity. or floating or non-commodity currencies, meaning the countries do not have significant exposure in their exports to one or multitude of global commodity prices. All together, 19 of the floating currencies are what is termed in the forex market as commodity currencies, meaning the country have significant exposure in their exports to one or a multitude of global commodity price. It sounds confusing, guys. For sure it is confusing, because I know this is your first time hearing this. It's your first time, because I know you don't know this information. If I tell you how I got this information or where, let's end it there. Okay. Then let me explain what is called. Okay. 4 of the currencies that have significant commodity exposure, GIO currencies or developed countries, the Hong Kong dollar and the Singapore dollar, that is SGD, are the only Asian currencies without significant commodities exposure that have a pegged or a fixed regimes. So what I'm trying to explain here is this: Hong Kong dollar and Singapore dollar, they are fixed currencies and they are controlled by government authorities. So it means the government can decide where this pair should go. Should we make this pair move in a certain range? Maybe it will move up 3 pips, then 3 pips down, or it will move 1 pip. They decide where this pair should move. So you should also be able to know which pairs to trade. You should be selective one, then you should know which pair to trade and which pairs to not to trade and why. Okay. The volatile opportunities is close to 36. So it means we have got 46 currencies on your trading platform. Then 10 of them are pegged. Then 36 of them are floating. It means those that are floating, they do not depend on 1 or 2 prices of a commodity. And also not of that particular country, 1 or 2 current countries. It depends on a commodities at a global stage. Then forex market floating, those that are under floating on those 36, I've just let me just give you about 4 or 5 developed float code. When I say developed float code, I'm talking about the currencies that do not depend on 1 or 2 commodity prices, and those currencies are in developed countries. One, we've got dollar, we've got euro, we've got Japanese yen, we've got Swiss franc, we've got Swedish krona, that is SEK. So these currencies are floating. It means 1, they do not depend on 1 or 2 prices. Number 2, those 1 or 2 prices, it's not only for that particular country, but they at a global stage. Then forex market commodity floating, developed commodity float. You need to understand this. We've got forex market floating. Then we've got commodity floating. It means we've got currencies that are based on commodities in developed countries. Those are the ones that I'm giving you now. Developed commodity floating, that is Australian dollar, New Zealand dollar, Canadian dollar, Norwegian krone. I'm not going to go much further today, guys. because this information is a bit confusing. What I want you to do is this. I was recording this thing. So from what you have heard, everything is new, but you need to take your time to master and understand, because I remember I was repeating. I explain, I repeat, I explain, I repeat. So I will just upload this video. Just go to our YouTube and you will see the video so that you have much understanding of these things. Because remember, when you are trading, you need to know why you are trading. Number one, why are you trading? Number two, which pairs and why do you choose to trade them? Do you choose to trade Forex market floating? The currencies that are not based on commodity prices, one or two, or you have decided, okay, let me trade those that are based on commodities in developed countries. In Africa, we only have ZAR. That is one pair that depends on commodity in Africa. So that's why you see it pays a lot of money. That is the reason why ZAR is okay. Yeah, someone is saying it's very true. The kind of information you're giving is very tough. For sure, it's very tough. What I want you guys to do is I'll upload the video. You go and watch the video. Take your time. Try to understand. If you have questions, you can ask on your own time, or you just ask on YouTube. There is a comment section. I will just reply to you so that others can hear as well. Okay, so today I'm not going to go much into this, guys. Let's end it here. Why? Because the information it looks like it's small, but it's bigger. So for today, I'm going to end the lesson here. This thing, I'll also send the document in the group. Just give me a few 30 or 40 minutes, then I'll post it. But I'll also upload this video on YouTube. So for today, guys, thank you very much. The information is too big for you guys, because it's something that is new to you. So let me end the video here. I've recorded the session, so I will also post it. So thank you guys for joining this meeting. Thank you. The information is big. So for today, let's stop here. I hope everyone is on the group. You or the group. So okay, I'll see you tomorrow, same time.